Started now. Good afternoon and good morning to our attendees in the West, and thank you so very much for joining the webinar today on navigating risk in the agriculture industry. My name is Lisa Bartko, and I am a Managing Director at Marsh Canada and the Agriculture Industry Practice Leader. Today I will be your host, joined by a panel of our specialists. Today's webinar will be approximately 60 minutes. The discussion will run for 45 to 50 minutes, followed by 10 to 15 minutes at the end of the discussion to address any questions, including those that we've received through the online registration process and those posted during the session. All participants are in listen-only mode as all lines have been placed on mute. We have already received a number of questions through the registration process, but we still encourage you to feel free to ask more throughout this presentation. To ask questions by clicking on the Q&A icon at the bottom of your screen or the panel to your right. Simply type your question in the open area. This session is being recorded and the recording will be distributed and available following the session. So before we begin, on behalf of all of us here today, a heartfelt thank you to all of the frontline workers everywhere who continuously provide essential goods and services during these extraordinary times. Thank you for your dedication and perseverance. We all truly appreciate you. Joining me today are 5 subject matter experts. Each of these individuals bring a unique perspective to our discussion. Joining me today on today's broad webcast are David Mew, who works out of our Toronto office and is the Vice Chairman of Global Placement for Canada. Today he will speak to us about the current insurance market conditions. We'll then have a panel discussion with Mark Aiello, who is also located in Toronto and leads our strategic advisory services team for Marsh Canada. And he will moderate our panel discussion on effective response in the time of crisis. Mike Pleon, Central Zone Agriculture Segment Leader, Tyler McLaren, Eastern Zone Segment Leader, along with myself, will join in the discussion to provide thoughts on how companies have responded, are recovering, and adapting during this time. Following that, we'll have a discussion with Trevor Mappleback, who also works in our Toronto office and is the Client Advisory Services Leader, a member of our Canadian Executive Committee, and he will provide an overview on captives. On to our discussion. A reminder, should you wish to ask a question, please use the Q&A button at the bottom of your screen. We'll address all questions during the Q&A section. We'll do our best to address all the questions submitted, but if we don't respond in the time provided, we will respond to you after the call. I'll now turn the discussion over to David Mew. David?
Yeah, thank you, Lisa. Sorry, I couldn't quite get to unmute there. Good afternoon or good morning to those in the West, to everybody. We'll go through a few slides here, but I'll probably talk in general, and some of the bullet points there will be for reference purposes only. As we look at where the current market is in Canada, as we come to the end of the second quarter this year, June 2020, we've come out of a very prolonged soft market. Prior to 2019, we'd been in a soft market probably for 15 or 20 years. There had been pockets where in certain industries, and after certain major hurricane events in the US, there'd been some spikes upwards. But in general, the market trend for the sort of 15 years, even 20 years prior to 2019 had been a downward trend. 2019, we started to see, at least in Canada, the property market change. I called it a transitional market or a disciplined market. Some other brokers described last year as going into a hard market, but really we weren't. It was a transitional or disciplined market. We started to see rates move upwards, particularly in property. The liability, not so much, but definitely property. As we got to the start of 2020, I think we flipped very quickly to what I would describe as quite a hard market. Property obviously had been changing last year and the gradual increase in rates started to increase quite dramatically during the first quarter of 2020. For the liability market, it was almost like a light switch. Come the beginning of January this year, it was like a light switch turning, and we've seen a very, very quick hardening of the liability market, especially on excess lines. So I would describe us now in what we would call a hard market. I would actually say, and I've been doing this close to 40 years now, both in London and in North America, I would actually say that we are probably entering some of the most difficult trading conditions we've had over that period of time. And unfortunately, as we'll see a couple of slides on, COVID-19 has only added to those difficult trading conditions. So what are underwriters doing? They are looking to return to profitability. The key word with almost all underwriters is they need to get their books back to being profitable. That measure for most insurers is what they call a loss ratio, and they try and get their overall loss ratios below 100%, in other words, to a level around somewhere between 93 to 95%. What that means is for every dollar of premium they take in, they're paying out somewhere between 93 and 95 cents in claims, and that gives them a profit margin, you know, somewhere in the 7 to 8% range. If we look at where insurers were at the end of 2019 and moving into 2020, very few insurers were below that 100% mark. In fact, a large number of insurers had their loss ratios in the range of 115 to 130%. In other words, for every dollar of premium they took in, they were paying out $1.15 to $1.30 in claims, and obviously that was unsustainable. So returning to profitability is a key driver. They're doing that by trying to get risks back to what they perceive as the technical rate. In other words, within their definition, the technical rate is a rate where over a reasonable period of time, they can make a profit writing that business at those rates. To get back to the technical rate, we are seeing substantial increases, and that is one of the challenge many of our clients are facing. Other ways that underwriters are trying to manage and get themselves back to profitability is to reduce their participation on accounts. In other words, manage their overall aggregate exposure to either any one region or any one part of the country or province or town or city, or on any one industry segment. In other words, you know, try and get a better spread of risk. And what we find is that as an underwriter reduces his participation, both on a property and we're now seeing on liability, the new capacity is a lot more expensive than the existing capacity, and that is helping to drive up the overall average rates. If you can move to the next slide, Lisa. So what does that mean for most buyers? And, you know, I don't want to sound too negative here, but what that is meaning right now is for most insureds, the average increases for property are probably approaching 25%. That means there are still some clients that are getting less than that. We see very few renewals getting renewed with reductions. We see a few very straightforward, simple renewals getting done at sort of as-is rates or close to 5 or 10% increases. We see a larger majority between 10 or 15. There are a number of our clients are experiencing rate increases, you know, anywhere over 40 or 50%, a lot of times because of losses or because of certain industry types they're in. But as you average that out, you're probably close to 25% for property now. Liability is probably getting close to 20%. We're not seeing that on your primary general liability as much as we are on the excess layers. It's more so on the excess layers that we're starting to see larger increases. Auto rates are increasing, but not to the same extent, and certainly in certain provinces, auto rates are somewhat regulated. Where we do see some very larger increases in the auto rates is where there's extensive US exposure, and that's because there've been a number of large US losses and US litigated claims that have made a number of insurers quite concerned about their exposure in the US. This is leading to slower turnaround time from underwriters. So it does take us longer when we go to the market to get renewals done. And one of the things that we're seeing, and this is a little bit of a reaction to COVID as well, is that premium dollars are the most important thing to insurers right now. So where deductible increases or where coverage reductions are occurring, it's really generating minimal cost savings as insurers look to retain and increase the premium dollars. Challenging risk industries tend to be seeing higher increases than what we would say normal exposures are. Unfortunately, for at least the agricultural sector, some of the agri sector do fit into those challenging risk industries, particularly with livestock exposure, and particularly with the less protected exposure in more rural areas. So that has become challenging. And overall, I would say the market is fairly unpredictable. That is probably the thing that we deal with most, is unpredictability from one insurer to the next. Could you just flip to the next page, please, Lisa? So how has COVID impacted the market? We have seen a significant increase in loss activity. I don't want to scare you with these numbers. These are global numbers, but there's current estimates in the global world that there's going to be somewhere between 30 billion to 100 billion of claims. Whether they all end up being true claims or whether this is just reported claims, it is a big number. And Canadian insurers aren't immune to this. It's been widely reported in the press. One of our larger Canadian insurers, Aviva, has potentially a very big exposure to COVID. Estimates could be anywhere between a 300 to 700 million type loss, which is a big loss for Canada. And that's because they wrote a program for dentists. So they wrote every dentist across the country in a national program. And within that policy, there was an extension for disease or contagious disease. And depending on how each province introduced their emergency measures, Aviva potentially has a fairly significant exposure. So where you would have thought there may not be claims, there are claims. The other thing that has impacted the market from COVID is a significant reduction in investment income. Low interest rates is going to have an impact on insurers at least for a number of years to come, probably 2 or 3, until central banks start reviewing that interest rate policy. So what that means is, if we go back to some of my earlier comments, it means that underwriters, to get themselves back to profitability, have to do it purely from their underwriting activities. Their ability to make up some difference through investment income is very, very much limited. And that's probably a consequence to COVID that a lot of people wouldn't see, but it is going to have an impact on the insurance market. What do we think the outlook will be for the rest of 2020? When we started the beginning of the year, we obviously look and try and advise clients as to what we think is going to happen in the market. When we started the beginning of the year, we thought that the rate increases would probably flatten out a little bit for the third and fourth quarters, because those were the quarters that were hit hardest in 2019 with rate increases. But that isn't happening. We see continued pressure on rates, and we think that is going to continue for the rest of the year and into 2021. And losses continue. Losses are continuing at an accelerated pace. And even in Canada, we have had two what we would call catastrophe events in Canada already this year. Fort McMurray and their flooding in the spring is probably anywhere between a $400 to $600 million loss event for the Canadian market. And then last weekend in Calgary, they had significant convective storm events and hail events. And the very early estimates on that could be as much as $1 billion of insured and damage. So, you know, even in Canada, we really don't have to go outside of Canada to see cat events that are impacting the market. We have them impacting our market here. So the outlook for the rest of the year is not great. We're going to continue to see increased rates. There are things that clients can do about it. You know, obviously, looking at your risk, good risk management practices, looking at risk control and recommendations and completing those will obviously set your risk apart and obviously allow us as your brokers to try and get the best possible terms in the market. But at the end of the day, the supply and demand and the continued discipline underwriting will probably continue to have an impact right the way through the rest of this year and into 2021. And as I say on the last bullet point here, there really is no single risk or industry that will be immune to this. We're seeing this market discipline right the way across the board. I think that's all I've got to say, unless there are questions that we can deal with in the end, and I'll pass it back to you, Lisa.
Thanks, David. Well, you've certainly given us a lot to think about, and I think probably what I mostly from it is if you're in a renewal process, start it early, because there's going to be a lot of negotiation and there's going to be a lot of back and forth, and insurance companies are going to want the information and want a lot of it. So thanks for that. We'll now turn the session over to Mark Aiello to moderate the discussion on the effective response in this time of crisis. Mark, go ahead, please.
Thank you very much, Lisa, and hello, everybody. So David spent a lot of time talking about the insurance market, but as he was transitioning at the end, he talked about the need for having strong risk management practices and risk control. And over the last several months, the term resiliency or resilience has been thrown around a lot. And we're going to spend a little bit of time right now talking about resilience. And if you think about a resilience model or a resilience framework, I like to break it down into two core elements: before an event and after an event. Today, we're going to focus largely on the after event, the response, recovery, and adaptation. But it's important not to forget about before, because that affects the after. You know, I think about the very first time I walked into a fire hall and I saw how the trucks were all packed with all of their equipment, everything neatly organized, and all of the clothing for the firefighters was so neatly put together. And I asked a firefighter, I was quite young and naive at the time, and I asked, you know, why do you do that? Why is everything so tidy and so ready? And the answer was, it helps us get to the fire quickly. We may not know what we're facing there, but it helps us get there more quickly. And it's that preparation in advance that, when you think about it, it makes a lot of sense. The more prepared you are before, the easier it is going to be to transition into that event. And so, you know, when I think about planning and as we come in or have come into COVID-19, I think there are very few plans, and I can attest based on my experience that no plans that I've seen would have prepared our clients for something like COVID-19. But that doesn't excuse not planning. It's important to have those plans available because even though you don't know what you're going to face, you know you're probably going to face something. And Dwight Eisenhower had a famous quote that said, in his experience in battle, he found that plans were useless, but planning was indispensable. And I think that's very important as we think through, you know, a little bit retroactively, how our organizations have collectively responded to COVID-19 and how we're entering into recovery and adaptation from it. So we're going to talk about these three elements, and response being really that immediate phase right after the risk event, where we're addressing immediate needs and enacting plans. There's a high level of uncertainty and a real focus from organizations on capital preservation because of that high level of uncertainty. The second phase, which many organizations entered it right away, and some are starting to enter it right now, is recovery. And that's a little bit more of that medium term. That's where we're taking that pulse check, understanding how our risks have changed and our value chain has changed. We're focused on rebuilding the capital base. And then the more long term is the adaptation, and it's transformations that you make in your business to operate in the new normal. How are we constantly adapting, and how has everything forever changed? Now you can see, as you look at these three elements, these are not mutually exclusive elements, and they can be happening and overlapping altogether. But we break them out just for sake of simplicity. What I'm going to do over the next several minutes here is ask a few questions of our panel experts here, and talking about those three phases. So the first question I'm going to ask is, I'm going to address it to you, Mike Pleon. So Mike, agriculture was classified as an essential service. And what did you see that were some of the key challenges that successful agriculture companies needed to address in order to minimize the negative impact on their business through this recession, or through this pandemic and into the recession?
Thanks, Mark. I think there's a couple that really stand out, and I think the largest, it's not exclusive to just agriculture companies, but the largest concern that everybody faced was, how do you address the safety and the well-being of your employees and your work staff? What strategies are you implementing to accommodate that? And I mean, that could include anything from establishing social distancing protocols, stay-at-home orders for employees that are showing up with signs of illness, and modifying employee work schedules to meet increased cleaning and sanitation needs. Another is an analysis of their current operations with a review and identify any potential weaknesses within their current supply chain. With processing plants and restaurants shutting down, the ability to move finished product had become a great challenge. Successful companies would have had to explore alternative avenues and techniques to send completed products to the market. And this could have included a shift in the reliance of domestic versus international partnerships. The other is establish mitigation strategies to address cost prevention and cash preservation. This ties into my previous point relating to the challenges imposed by the supply chain. Successful companies would have needed to create strategies to address not only the potential delay and difficulty in sourcing product, but having to acquire that product at an increased cost. And also a longer collection cycle due to customer cash retention, or their inability for customers to pay for services rendered during this period.
Sorry about that. I've been speaking on mute. My apologies. So, Mike, we heard you talk about people, and we heard you talk about the cash element of it. One thing I want to maybe zero in on is your conversation about the supply and value chain, and in particular, you talked about maybe a switch from international partnerships to more domestic partnerships, and how that's maybe created some challenges during this time. What are the areas do you think have been impacted the most in that space?
Well, I think the one thing that's kind of come to the forefront, and one of the areas that's been impacted largely is our ability to process and or process completed products here domestically. and having the capacity to do so. So as an example, we've seen the news segments with, abattoirs and meat packing plants being shut down, not only, across Canada, but within the US. And for example, the hog producers have run into this challenge, and it's been, where do we send our finished product? Where do we send the finished hogs? In many cases, there's been a historical reliance on these abattoirs and meat packing facilities in the US, which, we've seen them shut down, and, the farmers are left stranded trying to find a solution, and in many cases have been forced to euthanize their herd. The other area that's been impacted is the ability to source seasonal workforce for those businesses relying on migrant workers. For those companies that use migrant workers, there's a bit of a challenge when we're moving into that social distancing protocol. And in many cases, these workers are coming down for a season and are, group housed in close quarters. So the ability to follow those social distancing protocols is a struggle. And I think, as we've seen over the last week, Mexico has closed their borders for migrant workers to leave Mexico to come and work abroad, simply for that reason that their health and safety can't be guaranteed.
Excellent. Yeah, it's a huge challenge. So maybe let's focus or shift the focus a little bit to that recovery phase. And Mike, I appreciate your commentary on the response phase. And I'm going to turn to Tyler here and ask you, Tyler, from what you've seen in your role at Marsh, what are some of the successful agri companies focusing on as they progress through the recovery in this pandemic?
Mark, it's a great question. There's a few things our companies are really focusing on at first. First and foremost, it's the workforce, right? Everyone needs to make sure the safety and well-being of their employees is top of mind. And then following with that, it's making sure that those safety procedures follow the government regulations. So we talk about, instituting the safe physical distancing requirements, and these are very laborious intensive environments. So continually trying to monitor and manage that moving forward, make sure all the right temperature checks, safety checks, and make sure schedules are all done correctly so that there's not as much overlap, stuff like that. Then there's to talk about the operations as a whole. So we're looking at moving into a new normal where there could have been an overdependence of suppliers that now needs to be revisited, whether it's buying local or looking at alternative measures. And then understanding really the end consumer's new buying behavior. With the restaurants shut down for the past 3 months, a lot of consumers were busy at home making food, cooking for their families, and that may create a new trend moving forward. So looking at alternative ways of getting their product to that end consumer, with restaurants opening up but only partially available, there's going to be a bit of a gap there. So there's continuous monitoring that. And then when we talk about the cash preservation and reduction, that's an ongoing topic for companies as they move out of the response phase and through this recovery phase of continually monitoring their cash flows.
Thanks, Tyler. So you mentioned, kind of strategies to monitor or activities to monitor that cash flow, especially around, I guess, cost reduction and cash preservation or capital preservation. What activities are you seeing or what types of strategies are you seeing organizations engaging in to help with that capital preservation?
Mark, every company has its own special challenges, but some of the things that many companies are looking to do at this juncture start with one of is the insurance policies and revisiting their exposure base within those policy structures Revenues are down, and revenues completely correlate with liability and business interruption. So looking at that spend there and understanding what makes sense, and could there be some monetary relief from their insurance on their property and liability side, but also their vehicles. Many companies, if they have some form of fleet, may have had some vehicles parked for an extended period of time. So could there be some monetary, again, relief there? And it's definitely something that during these renewal negotiations with insurers, we'll be bringing to the forefront. Every organization reach out to their banking facility, I imagine, pronto, looking at understanding how their payment terms are for their operating line is being used. Is there ways to extend them, maybe limit the amount of principal that gets for repayment? Some of what successful companies have done during that whole negotiation with their banking facility is actually looked at how that calculation is created and what's more form or percentage of their receivables are being built into their working capital calculations. And then once they understand that, then they've looked at leveraging trade credit facilities in these discussions to actually enhance the percentage allowable in their working capital ratios with the bank to increase their operating line of credit. So allow for better cash flow, use of cash flow. You know, in the agri industry, there's some bonds, for instance, like grain terminal bonds or possibly transport bonds that, you know, some companies were using letters of credit for, you know, where, adapting a bonding facility and getting back that letter of credit to be reused elsewhere. And then finally, we're seeing companies actually really investigating alternative risk transfer vehicles, whether that's deductible changes within their portfolios, captive offerings, all that compared to what they're traditionally doing.
This is very interesting, and as I listen to your response, Tyler, there's a lot of symmetry with Mike's response. There's a focus on the people, there's a focus on the operations, there's a focus on that capital. So there's a lot going on. What next? What are the next steps in facilitating this recovery for agri companies?
Well, risk management is going to be the forefront of many things. So, I guess what we're seeing is companies need to look internally with full engagement of their leadership team and revise their goals to the new normal. What does that really look like? How are we going to adapt into this new era? How does that affect our risk appetite and tolerance moving forward? Are we willing to take on more risk or not? Shifting consumer behaviors. How's that going to influence our position throughout our value chain? Are we completely risk adverse company, and are we willing to take on a larger share of risk to transfer and preserve our cash flows? What sort of vehicles are out there that we can use to help leverage and enhance our balance sheet positions with lending institutions to create more available cash as we adapt through this phase? These are I guess ultimately there are questions that companies are going to have to look internally at as they move through this to the new normal, through this recovery phase into adapting to the new normal.
Thanks so much, Tyler. That's very informative. Now, let's spend the last few minutes of our discussion on the adapt phase. And as I mentioned earlier, all throughout these response and recovery phases, there's a significant level of adaptation. And so I again, these are not mutually exclusive, but I want to turn to Lisa now. And as we're seeing, Lisa, some of these, these changes, and as agricultural companies are adapting to a new risk environment and a new reality, what are the imperatives that these organizations are focusing on from your experience?
Yeah. Thanks, Mark. It's interesting because when you go through the response, recovery, and adaptation, as you say, they are so entwined with one another. But I really think that there's 4 basic imperatives that agriculture companies are going to need to focus on. Their companies are going to need to continue to look towards reducing cost and preserving their liquidity. As Tyler mentioned, from an insurance perspective, companies are going to want to reset insurance exposure-based insurance policies. They're going to want to right-size their insurance premiums, as well as perhaps premium finance those premiums. Companies are also going to look for that further risk transfer, such as trade credit and, surety, and in some cases, captives may also be looked at depending on their risk appetite. So I think that's the one thing is that they're certainly going to want to continue in that trend. Secondly, companies are going to want to look at ways of how they're going to reemerge healthy and strong. And, both Mike and Tyler have talked about employees, and there's really going to be a need to analyze and understand the range of pandemic impact on employees and those health plans that are going to be needed to be provided. And how are you going to budget those further health plans? I think that, companies are starting to think more about the mental well-being of their employees and what is going to be the future impact, and especially as they attract those employees to the agricultural industry. There is going to be some cost from a health plan perspective, and I think there's going to need to be some analysis on that. Workforce safety is going to be evaluated, emphasis on safety screening, your further training, communication. Work sites are going to have to be modified, as well as work practices. There's going to have to be protocols set for workers and vendors that are going to be going into these organizations. I think it's going to be important to have a work playbook to help you reemerge healthy and strong. So you're going to need to consider things like, what does your coronavirus era workplace look like? How are you screening? Tyler and Mark, I think, both mentioned, how do you care for those ill employees, and how do you prepare your employees to return to the workplace, and how clean is clean, and what are the new safety considerations that need to be made? I think also the third imperative will be that companies will look to improve pandemic resilience. So I think lessons learned from the recovery stage and the response stage, you're going to really want to take a close look at that. Redesign your crisis management procedures to respond to those future events more effectively. You're going to want to look at the impact of supply chain and where there's potential exposures, and quantify how those might impact your revenue in your organization. So I think also we've learned very, very quickly the impact that with how we've relied on technology and how much technology has needed. The use of it's been increased, which of course raises the cyber threats, and we need to really evaluate those risk mitigation strategies and how we protect ourselves. I think lastly, and I touched on it in the third imperative, but you really want to optimize your risk management strategy. You want to consider risk planning workshops to look at emerging risks. You want to look at your risk profile and how that risk now affects your total cost of risk as opposed to how it did pre-COVID. You really just want to be able to prepare objectively for future adverse events.
It's interesting, Lisa, when you talk about all these actions in the adapt phase. And, with every decision that an organization makes, that opens up a whole new risk profile and evaluating that risk profile. But you talked about one thing that you talked about in the last response was about reemerging from this. And so maybe you can share your thoughts on what some of the leading agribusinesses are doing to come out of this pandemic as winners, maybe on that front edge of the curve.
Sure, absolutely. I think that there are several things that they're doing to come out successfully post-COVID. One of the things is that companies are establishing effective and open communications with their employees, customers, and community. And when I say that, I think that successful agribusinesses are going to be in touch with consumer trends. We're in an era where we're looking at alternative protein, we're looking at traceability, we're looking at, you know, the use of GMO. And I think that that's not going to go away. I think that we're going to want to still really be in touch with that. I think that companies now are for a long time forward are really going to have to focus on widespread cost reductions and cash management, because that's what's going to strengthen their liquidity. And I don't think that they'll be able to lose touch of that. There's going to be a focus on evolving business models to contend with farm sustainability. They're going to need to decrease interdependence on food supply among countries, as well as shorten the production and supply route. And, you know, Mike touched on that in the example of livestock producers. And so, you know, they might look to no longer, or ship their livestock somewhere else that has a shorter supply route. Business models may be pivoted to take advantage of growth and strategic opportunities, such as mergers and acquisitions. And again, I refer to the hog producers. Instead of sending out their livestock for processing, they may, as a success story, now lengthen their own operation to become a processing plant. Companies will need a resilient supply chain. Instead of relying on, one major supplier, I think they will no longer rely on just a single source. I also think that there'll be a preference for local rather than global. We've seen, a lot of the disruption, especially this is not so much Agri, but, in the automobile industry, we are finding that disruption on what's happening. And, from having so many of those parts that we get from China. I think also there's going to be stricter measures throughout the world just to protect employee health and food security. And I think that's going to make sure that, agri companies continue to be successful.
So lastly, you've just talked about the winners, or what organizations are doing to come out as winners. What are those cautionary tales, or what are the things that organizations can do or fail to do that will leave them behind the curve?
Yeah, thanks. I think that answer is fairly short. I think, companies that fall behind, it's because they're unwilling to change due to financial, operating or human capital constraints. They might just not want to change. They might not provide adequate solutions for consumer taste. We talk a lot about, consumer trends and tastes, being at the forefront in the agri-food industry. And it's just that they're not willing to adapt to those changes. Also, companies that are just not willing to create stickiness and don't give a compelling reason for their products to be bought by other competitors instead. I think those are just, in short, the answers to why companies won't succeed post-COVID.
Thanks, Lisa. It's a very interesting time, and we've heard a lot of common themes through this segment here, and it's interesting. It reminds me of one of my favorite singers, a very popular Canadian singer who, after releasing a very popular album in the early 1970s, decided that it made him popular, and he was bored of driving down the middle of the road, and so he took a turn toward the ditch because it was more interesting. And I feel that COVID has really put us in the ditch, and in a morbid way, the industry is more interesting now. There are more interesting problems, but this individual, this singer, although he made a conscious choice to do that, and we're not in a conscious choice, 50 years later, is still producing top-selling albums. And so the interesting parallel is that if you go into that ditch and you can continue to create, you can come back stronger, and you can come back more effective than ever. So it's been a very interesting discussion, and I thank the three panelists for this. And what I'd like to do is turn it back to Lisa now to have maybe we can have some commentary, and then turn into captive conversation.
Fantastic. Thanks very much, Mark, Tyler, and Mike. That was great. You know, we all live this every day, and so it is interesting as we move through the stages. And quite frankly, I find it fascinating that, you know, March 13th, you know, Marsh in particular, you know, went into lockdown, and I find it fascinating that we're now sitting at June 18th, and you know, where has that time gone? But so much has transpired during that time. Anyways, Trevor, I'll turn it over to you so that we can have a discussion on captives. Thank you.
Great. Thanks very much, Lisa. So we're going to get into a slightly different topic here. It kind of aligns with what David referenced, along with the conversation that Mark just facilitated as well. I'm going to point out, though, Mark, that we all do need to recall that you know, intentionally going into the ditch is probably not the most appropriate thing from a personal safety perspective. And a good friend of mine has always stated in adverse weather conditions that remember, Trevor, for every mile of road, there's always 2 miles of ditch. And so we need to be somewhat cognizant of that. David alluded at the outset to the dynamic or the changing or the hardening insurance marketplace, especially around property insurance. So at a stage where a lot of organizations are you know, cash constrained, are going through some economic challenging times as a result of COVID, now is not necessarily the time that we want to be looking at, you know, significant increases in insurance premiums and things of that nature. So a lot of organizations that we work with have evaluated whether a captive insurance company could be a more appropriate way to finance some of the insurable risk profile that they have within their organization. And so we're going to talk briefly about what a captive insurance company is, and then talk a little bit about some of the benefits or the rationale for why organizations may choose to look at captives. So apologies for those who may have some knowledge already, but I'll quickly run through this slide. So a captive insurance company, often used by multinational organizations to what we say is optimize their insurance and risk management programs. Historically, it was really only multinational companies, those that had operational footprint outside of Canada, who really were interested in captive insurance companies. In essence, they were created, if you will, for the larger organizations, larger, more complex organizations. In the past 10 years, though, that trend has significantly shifted. We see an awful lot of domestic-only operating organizations who look at captive insurance companies to help finance some of their insurance and non-insurable risk profile. So, what is a captive? A captive it's a licensed and capitalized insurance company that is set up to insure principally the risks of the owner, of the shareholder. So the risks of, you know, your own operations, your own physical plant, equipment, vehicles, third-party liability exposures, et cetera. Some organizations do choose to kind of offer insurance, if you will, out to third parties, you know, customer base, offering extended warranties if you're selling equipment and things of that nature. But that tends to be a fairly small minority of organizations that do run captives or create captives. So when I say that they're licensed, capitalized, and they're set up to ensure the risks of the owner, in essence, these are subsidiary organizations of the parent company. Where are they located? Typically, for Canadian organizations, more often than not, they're going to be offshore in one of the captive domiciles in typically, again, the Caribbean. So what we see is Canadian organizations operating in Barbados, Bermuda, or the Cayman Islands. And we'll get into a little bit of the rationale for that around tax strategy. If you're looking at a Canadian-only captive or a Canadian domiciled captive, the only province that does have captive enabling legislation is British Columbia. So, you know, I think that as a result of that, most organizations do look offshore. The rationale for looking to Barbados, Bermuda, and Cayman Islands is that there is either a tax treaty in place between Canada and Barbados, or what's known as a tax information exchange agreement between Canada, Bermuda, and the Cayman Islands, which creates a little bit of potential tax benefit, specifically around insuring risks outside of Canada. So we can get into that a little bit if anybody has any questions around that. It is a regulated entity, so it does have capital requirements. You do, in essence, it requires some additional governance associated with it, and they're regulated by the regulators in the domicile in which the organization is incorporated. So if you set up a captive in Barbados, you're going to be regulated by the Financial Services Authority in Barbados. So for a lot of companies, if you do have international business corporations to help kind of enable export sales and things of that nature, oftentimes you're going to leverage and utilize the same geography, the same country as you have an IBC already set up. Obviously, you would have the governance in place. You would have supply kind of professional service suppliers there, law firms, banks, etc. When we look at captive insurance companies, really they do need to be looked at a long-term solution. Because there are initial capitalization requirements, there are other governance requirements in place, et cetera. We want to make sure that if you're evaluating the use of a captive, you're not looking at it to get through this 1 or 2 year, hard market cycle. If it is in essence that short, you're looking to set up a vehicle really to align with your appetite to take risk on, to remove some of that volatility or variability from the dynamics of the insurance marketplace, and look at this as a minimum 5-year commitment, if you will, of your organization to manage and self-insure some of the risk that right now you're insuring through risk transfer within the insurance sector. Elisa, if you can just flip to the next slide, please. So why do organizations form captives? There are a number of reasons why. I'm going to focus just on the 12 o'clock and the 2 o'clock section here around cost and capacity. The primary reason is going to be cost. So David mentioned, the loss ratios of the property and casualty insurance sector and their need to kind of right-size their books, if you will, get back to a level of profitability. If we unbundle how an insurance company makes profit, obviously, they take in premium, they pay out losses, but they also have overhead costs like any other organization. And if we think about kind of that fixed cost for a property and casualty insurer, it's typically running between around 35% of their cost base. So right there, some of your premium dollars are being remitted to the insurance company to pay for their overhead. So there are, to operate a captive insurance company can be done much more cheaply from an annual operating cost than an insurance company operates at. The big thing really is how we recapture underwriting profit from insurers. We know that insurers, the old adage is they collect a premium from the many to pay for the losses of the few. And so, you could look at your own experience and say, in 10 years, we've never had a claim. So why is our premium going up? The premium is going up because of the state of the insurance marketplace. But you look at that and say, well, how can I then insulate myself from some of those dynamics? Every policy that you have in place carries a deductible. So what if we look at taking that deductible up from where it is now to a higher level and basically take that and self-insure that additional risk area? So in essence, what you're doing is taking your deductibles higher and therefore reducing the overall premium level in a certain manner. So you can take that differential between your old deductible and your new deductible and put that into a captive, underwrite that risk within the captive, and the profits that you generate within that layer of insurance, in essence, go back into your pocket and into your subsidiary company, the captive insurance organization. There is a kind of a tax efficiency component to it as well. Again, I mentioned on the previous slide that organizations who have operations outside of Canada and are paying premium associated with the operations outside of Canada, for any premium dollars that you pay to your own entity, those premiums are deemed to be tax deductible in the country in which that organization is operating or which that subsidiary is operating. When you pay those premiums into your captive insurance organization and you generate profit from that and investment income from that, those profits are taxed at, in essence, a 0% tax rate in Barbados, Bermuda, or the Cayman Islands. And because of those tax treaties or tax information agreements that are in place that I mentioned earlier, those profits do not accrue or incur any additional tax impact in Canada. So those profits, a portion of those can be sent by dividend or by intercompany loan back to the Canadian organization without any additional tax penalty. So kind of look at that as a bit of a tax arbitrage capability. So that's probably the key area around that. I'm cognizant of time here. I want to keep it open for some Q&A as well. So what I'll do is I'll stop it there, and if there are any questions specifically around captives, Lisa, I think, is going to coordinate the Q&A section. So Lisa, I'll turn it back to you.
Yeah, thanks very much, Trevor. So we only have a few minutes for Q&A, but as Trevor indicated, any of the ones that we're unable to answer during this session, we will get back to you personally. So as a reminder, click Q&A button on the bottom. In the meantime, we've had several that came in with our registration. Perhaps I'll ask this first question of David. Given the current market conditions and future outlook, how do insurance companies view agriculture companies on their own versus being part of a larger agri collective? And David, I'll remind you, we only have a couple of minutes. Thanks.
Oh, thanks, Lisa. Look, at the end of the day, agriculture is a class that not all insurance companies in Canada write. For some of them, it's a restrictive class, which means it's lower limits. For others, it's a class they don't write. And for some, it's a class that they happily write. There's, because there's limited competition, at the end of the day, the larger critical mass an insurance company has, overall, they should be able to offer better terms and conditions. And that's been the basis on which, we've tried to broker business and, tried to take business to the market. But I would say right now, in the current market conditions, regardless of that, underwriting discipline, underwriting guidelines are almost applied to every risk, and they get them to a technical rate, and the amount of business that they have really doesn't matter. It's getting to that technical rate that is the most important thing.
Thanks, David. I actually think that we are closing on 2:30 for Toronto and 12:30 for Saskatchewan, and just the morning in the West. So I want to thank everyone for joining our session today. As we said, we will get back to you with any outstanding questions that you have asked. We hope you found the discussion insightful and informative. There will be a survey sent out following the call, and your input will help us ensure future events are impactful. Thanks again, all. Keep safe and well. Thank you.